Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
Hi, I'm Imogen Bachra, and this week I'm delighted to be joined by our global market specialist, Stuart in the US, and Joann Spadigam, who is joining us live from Germany. Right, let's start with the US this week because I think that has been where we've seen the biggest market moves. This week we've seen, or over the last couple of sessions, we've seen a major turn in risk sentiment, Stuart. So we've had, risk assets perform badly. We've had treasury yields fall a very long way off the back of another string of policy announcements from the new administration. It feels, from a risk asset perspective, or from a US asset in general perspective, I would say they're leaning very heavily into the kind of negative growth risk side of the story of the policy announcements from the new administration, rather than the potential, quite high inflationary risks as well. But a lot of that growth risk is really just stemming from uncertainty there's a lot of uncertainty about a lot of the policy measures that may or may not be coming in. My question for you, I guess, this week is, at what point do you think this sort of uncertainty shock becomes a genuine growth shock?
There certainly has been a big shock, and the way we're framing the question is what we've experienced as a financial shock, and how does that become an economic shock? Obviously, it's going to require a change in behavior from someone. The two, I think, prime suspects here should be households, so the personal savings rate, and then perhaps the corporate sector through profits. So we've gone back statistically to look at how these things are related. And the first thing I would point out is it wasn't necessarily the easiest statistical task, but we have been able to show some linkages. It turns out that the magnitude of shock that we've seen to a policy uncertainty index is consistent with about a 1% increase in the personal savings rate. I would add that that's what we saw as a response to the January personal income and savings data, about 1%. So it could be in the price, so to speak. And then secondly, we saw that these sort of linkages versus the corporate sector would imply something like a 4% decline in profits year on year. So on its own, it's potentially very significant, but we just have to see exactly how much pass-through there is. What determines that pass-through? What we've found statistically is that the uncertainty index is highly correlated with some unsurprising variables, especially joblessness, wage growth, that sort of thing. So what we're going to have to see before this becomes an economic shock vis-a-vis a financial shock is a turn in employment, a decline in income generation, none of which is yet observable in the data. So we're in a wait and see sort of environment at the moment. I think that historically the reaction falls somewhat short, I think, of the magnitude of even the regression implied magnitude of response to the shock. We're waiting to see. Our investment thesis remains that the spending behavior will continue as long as income generation is strong. And it was the case that we're still very much within the historical range in terms of income generation and personal consumption expenditure. So again, it's not the data, and I think the persistence of this sort of turmoil, I think, ultimately will take a toll. I think the message is a transitory period might not. My personal bias is that's what we're looking at. Essentially President Trump negotiating with various counterparties. And the marketplace, I think it's probably a means to an end. And from that perspective, my personal guess is that it won't persist. And in the end of the day, income generation and consumption will sort of, drive markets. And those look still quite healthy.
I think a lot of listeners might have shuddered at the sound of that word transitory again. It feels very, very 2022 to be talking about pressures being transitory. So you talked a little bit then about being in wait and see mode, but of course market pricing, as we both alluded to, is now quite a long way from what we would think the Fed's reasonable base case could be. 75 basis points-ish, 325 basis point cuts of easing is being priced into the front end of the curve. I guess it sort of goes without saying from what you've said then, but that feels like too much versus our base case. And what will you be watching to bring markets more on side with our view, and over what kind of a time horizon might you be thinking that they can come, reprice more closely to our base case expectations?
Well, I think it's just going to be down to Fed communication. I mean, the points I've made with respect to the Fed are that, number one, they're offsides with respect to the inflation mandate. They cut 50 basis points into extremely easy financial conditions. There is at least nominally, pro-growth administration, although perhaps these tariffs fly in the face of that. And now, of course, we have the tariff shocks themselves, and so obviously there is a price level or inflation impact, and there is a growth impact. Markets have been focusing on the growth impact, and I think in a very risk-averse fashion, i.e., outstripping historical correlations. But the Fed has to be somewhat uncomfortable, because another trend we've seen is sort of telling signs of a drift higher and longer-term inflation expectations. The most recent Michigan survey was at a historically high level, 3.5%, going back to 1995. Just the location of 10-year break-evens is in the top 15% of observations historically since the product was launched. So there are survey and market-based. Bear steepening, I think, is another market-based sort of warning sign for the Fed that this could once again leave them with some egg on their face, akin to the transitory thing. So my expectation is that they will err this time on the hawkish side. I don't think they'll be back in the market raising rates at this point. But again, I think that the market balance is very delicate, and language of the sort that, although we perhaps would like to ease, conditions won't allow an ease at this point. And that, as I've said before, has had a distributional effect, pushing probability mass towards higher rate outcomes. And that is what will drive market pricing. When do we get that communication? I'd say potentially any time, because again, what we're getting is a taller stack of data points that point to instability in long-term inflation expectations, and that is anathema to any central banker. So I would expect they're in the quiet period now, but at the March meeting and thereafter, they're going to have to explain a cut or the failure to cut, and we come down on the failure to cut. And I think that is a rich sort of period in which we could hear the sort of language to shift market pricing in the way I've described.
Do you think they could formally change the guidance at the March meeting, or would they be looking to use their dot plots to signal, a very different, slightly more hawkish message? That meeting is only next week, as you say, or do you think it will come in the flurry of speeches that we will have after the March meeting?
Well, I think that, in my own opinion, the speeches are a more likely source of information here. In terms of the dot plots and forecasts, my guess is they're going to try to change as little as possible, given the uncertainty with respect to both the growth and inflation outlooks. We keep saying it's a wait and see situation. The Fed is in the exact same boat, but again, they're in a disadvantaged status. So I would actually argue that they, at this point, should have an axe to defend their mandate on inflation, vis-a-vis growth, where there is a threat, but again, not yet in the hard data.
It's similar, I guess, to the sort of wait and see approach, Stuart, that you've talked about from the Fed as the BOE as well. And we have uncertainty, I think, driven by different factors. We're clearly not here in the UK high up on the target list for the new administration's tariff policies, but we have a huge amount of uncertainty related to the growth and inflation outlook stemming from domestic policies, and particularly from the national insurance contribution hike. And how that's going to play out. So it's not just the Fed next week, but we also have the Bank of England that will be meeting. The market is pricing, I think, maybe, I haven't checked this, but probably the lowest ever amount of easing that it's priced for the last couple of meetings, at less than 1 basis point now. So the scope for surprise, I think, on the rate side, or certainly in terms of the action on the rate side, feels quite limited. And unlike the Fed, this isn't a quarterly one of their monetary policy report meetings. We obviously just had that in February, so there's no updated forecasts, updated projections, and there is no press conference either, which means it all comes down to the rate decision, the vote, and any guidance within the minutes themselves. As I've been through, I think it's very unlikely that they do anything on the rate side. They've all the majority have conformed to this gradual guidance. And although the BOE have never explicitly confirmed what gradual really means, of course, since they've been using the gradual guidance, that has sort of inferred a quarterly pace of rate cuts. So this wouldn't be the meeting for them to cut rates at anyway. And although we didn't get big shifts in the guidance at the February monetary policy report meeting, incrementally, it was quite clear, I think, that there had been an underlying shift amongst the majority 7 in a slightly more hawkish direction. And that was contained in the minutes. I think we've talked on this podcast before about that paragraph 12 in the minutes that said that the majority amongst the committee saw more evidence pointing to cases 2 and case 3, which are the slightly more hawkish scenarios on the inflation side, than on case 1. So again, it doesn't feel like next week is necessarily going to be the moment for the BOE to change course significantly in terms of their guidance. I think they might have to eventually. You know, we think that they too might be in this kind of wait and see mode, and stop cutting rates by the summer. But it feels like if that's the direction of travel, then they probably will have enough time until the May meeting before they really need to refresh their guidance. So from a market's perspective, you're really then just left with the vote as potentially being market moving. I think the market will be very caught up on what Catherine Mann does or doesn't vote for. We know previously she surprised all of us by having not voted for rate cuts throughout this whole cutting cycle, to then taking what she describes as an activist approach to voting for a 50 basis point rate cut at the February meeting. Of course, only 25 basis points of easing was delivered, so it's unclear whether she thinks we need just another 25 basis points of easing. She'll vote for another 50, but we think that she will still continue to descend in the dovish direction. So we think the vote will be 7-2. You have Dingra and Mann still voting for 50 basis points. The risk cases, I think, are either, like I say, that Mann doesn't vote for 50, but instead for 25 basis points, or Alan Taylor potentially votes for back-to-back cuts, but even he has started to sound slightly more hawkish, I think, in when we heard him at the Treasury Select Committee compared to his January speech, which was very dovish. At the Treasury Select Committee, he talked about seeing risks as now being two-sided on inflation, whereas previously he saw them as only being to the downside. And that's really this incremental hawkish shift that I've been talking about. Even the doves, so Taylor and Ramsden, who previously voted for back-to-back cuts, are now starting to see more kind of two-sided evidence around the inflation outlook. So that was a very long-winded way, I think, of saying that I expect it to be a relatively unexciting meeting, because even if markets get hung up in the very near term on what Catherine Mann is doing and how she is voting, I think it's clear now that she is not really a leading indicator for how the majority of the committee may or may not move over the coming months. And I think we've heard from enough of the committee over the last couple of weeks since the February MPR to be confident that that kind of majority 7, they all have shifted incrementally slightly more hawkish. And that's from the very doves at the one end of the spectrum up to Green and Hugh Pill, who, of course, are sort of shunning the BOE's slightly more dovish interpretation of the words gradual and careful in favour of what the BOE have decided is more hawkish, cautious and gradual. We can debate whether cautious and careful really mean two different things, but they think that they do. So from a UK markets perspective, we're still left being somewhat of a sideshow, I would say, to what's going on elsewhere. Of course, US fixed income has been moving in very different directions to euro area fixed income on the whole over the last couple of sessions, and that's largely about, of course, this fiscal story and the German fiscal story as well. And we spoke in depth last week about how the UK had broken down its correlation between moving with US rates, basically with a beta of 1, to now moving much more closely correlated to the euro area rates, which to me feels like a fairer reflection of the underlying fundamentals in the UK at the moment, because I do think those fiscal risks are still quite prominent. And I do think that the Bank of England is going to be more concerned about the upside risks to the inflation outlook than they are about the more distant downside risks to the growth outlook. But I think a boring touchwood BOE meeting leaves us very much as a sideshow. And then we will just be watching for the spring statement, of course, in the week after. Okay, let's switch gears a little bit then and join Joe, who I'm excited is joining us live from Germany, which feels like where all the action is happening at the moment in the euro area, or certainly where all the focus is from a euro area fixed income perspective, because the debate today has started in the Bundestag ahead of a vote next week on whether the fiscal package and the debt brake reform can be passed in the current parliament before that gets dissolved into the new parliament, which will be the results of the election that we had just a couple of weeks ago. There's lots of nervousness in the market, Joe, that actually the Greens and other political parties might be able to put up enough of a fight that this doesn't get passed ahead of the 25th of March. And therefore, we're sort of back to square one with the new parliament, where the makeup is a bit less favourable for getting things like debt brake reform passed. What's your take on that? And I guess, perhaps importantly as well, what have you been hearing from German clients since you've been out there over the last couple of days?
So the Greens have caused quite a lot of market volatility, I would say, this week, particularly in terms of the headlines we've been guessing, suggesting that they may not be on board with pushing the German fiscal package through that we need. I think that what's interesting is that on the ground in Germany, the feeling really seems to be that this will get passed in some form. The Greens really are here as the kingmakers and are essentially, I think, using this as a negotiation tactic in order to get a little bit more concession in terms of, for example, more green-friendly spending or a more broad definition of what defense means, pushing the limit on how much defense can be excluded from the debt brake and such. So I think that it seems to me that what is happening is that the Greens are essentially trying to get the best for themselves from this package deal, and something will be passed in the next week. And the most pessimistic account I spoke to in the last couple of days seemed to suggest there was only a 5 to 10% chance that this doesn't get pushed through. So I think for me, the base case still continues to be that this fiscal package will be pushed through. In terms of the timelines, I think that next week will be particularly important. There's a Bundestag meeting on the 18th of March and a Upper House Bundesrat meeting on the 21st of March on Friday. So these are potential dates to look out for in terms of risk events, but I think that in any case, they will try to push something through before the new parliament sits, which is on the 25th of March.
Relatedly, we've caught up over the last couple of weeks against a backdrop of quite significant moves in fixed income. German Bund yields rose the most that they had since 1990 one day last week. But we appear to have settled currently in this higher range, certainly of longer dated yields for the moment. Where do you think the direction of travel is from here?
Yeah, so as you say, Imogen, we've been bearish rates for a while, and I think that my bearish conviction has only been reinforced by recent events. We target 10-year yields at 3.2%, so that's in bunds. And I think that comes with a couple of reasons. So firstly, I think the bullish pressures that we were talking about earlier have now subsided quite drastically. At the end of last year, lots of questions were around the growth picture in Europe and that being essentially skewed to the downside. I think that's clearly no longer the case. And what this fiscal package has done is that it has taken out the tail risk essentially that we get rates significantly below where the ECB neutral rate is, which is around 175 to 225. So with that tail risk removed and essentially the more negative growth picture removed by the fiscal package, it's quite difficult for me to see any bullish pressures materializing in the short run. Of course, if this package doesn't get passed, we will essentially undo lots of the move we've seen in the last week. But I think that given that's a pretty low probability event, the bearish side of the picture does continue to dominate. In terms of thinking about bearish risk, I think the fiscal policy outlook is clearly the big one here. The market has been, I suppose, to and froing quite a lot in the last week, and that will be pretty difficult, I think, in terms of pushing that across, in the sense that I think that if we do get a deal pushed through, we could essentially see rates pushing higher because of it, given that there has been some negative sentiment surrounding that in the market in the last week. And I think that at this point, we clearly don't have that much information about what the actual package will entail, what it will be spent on, whether that will be coming out of this year's budget or the next year's budget, or if that means that supply changes now or later down the line. And I think when we do have more information about that, that could be another impulse for more bearish pressures. When I'm thinking about the supply picture, I think for 2025, that should be more or less unchanged, particularly given that we have a flexibility in the current supply picture for Germany. They've got cash reserves, they've got flexible instruments they can use, they've got bills, which are short-term instruments that they can use. Whilst I think that for 2026, that's when the more material impact in Bund funding could occur. So we could see a more material increase in supply in 2026 versus now. But clearly, I think that will be an announcement effect when we get more information about that, which is unlikely to happen until the second half of the year. But that's it for me. I mean, I think, again, the supply picture really is important. It's a global fixed income supply story, not just a European one. So that clearly also adds to my bearish conviction.
Okay, let's leave it there for this week then. Thank you, Stuart, for joining, and Joe, live from Germany. And of course to our listeners for listening in. Plenty to talk about as ever, but like I say, we will catch up next week following the Fed meeting, following the ECB meeting, and following that first round vote of the German fiscal package in the Bundestag. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.